Your oil market strategist at Energy Aspects. Jeremy, great to see you. Thanks for coming on the show.
Hey, great to be here, Andrew.
Your thesis here is that the market has been underestimating the impact of these big new sanctions against Russia.
Yeah, well, it's definitely going to take some time to play out. Where high-level estimates, we see 500,000 to 1 million a day of Russian crude deliveries into the Asian market being disrupted, and for it to take 2 to 3 months to really play out and any workarounds to really be put in place.
So, and I saw Macquarie is saying, well, in the most extreme scenario, 2.2 million barrels a day could be affected.
Yeah, I mean, it's an evolving situation. There's a lot of estimates out there. We definitely see China and India as the most affected parties, and we're seeing that in the market of them going out and aggressively sourcing some alternative barrels.
The interesting thing here is that the Americans are tightening their focus on the tankers. Of course, they have explored routes in the past of going after insurance for tankers and various types of services.
Yeah, so this round of sanctions really included vessels, but it also included insurance and some major oil and gas producers in Russia.
What about the demand outlook for oil? I see the International Energy Agency is walking back some of its forecasts for supply excess, a glut of oil.
Yeah, certainly something we're seeing in the market as sentiment is slightly changing, and there's a lot of bearish fears of there being an oversupplied market in 2025. And now we're seeing balances tighten marginally as I think people digest the ideas of less Iranian crude on the market. Now these sanctions on Russia have really tightened things up, and that's being shown in fundamentals and both time structure on the benchmarks, especially in the near term.
What do you mean by that? Near-term oil going to a premium, for example?
Well, more so the level of backwardation we're seeing in the time structure of the global benchmarks. So it's showing that there's a bigger premium to get the prompt barrel, and therefore you're seeing the front end of time structure price at a higher premium to, say, oil 6 months down the curve.
And that does, of course, suggest a market that could be near-term tight for supplies.
Yeah, exactly.
What is there anything investors are missing, though, in the oil market right now? Because, of course, higher prices do bring higher supply in any commodity.
Yeah, I really think you're not going to see a huge influx of supply in the near term. I think that's more of a longer lead dynamic. And especially with what we've seen this year with non-OPEC supply growth disappointing largely at, healthy prices, a lot of people would argue. We just don't really see there being a supply glut anytime soon. And the price sensitivity of that response would take time, and you'd have to see kind of full strip pricing even a year out so the producers could hedge and lock in some of those profits, be probably materially higher than where we're at today, even after the run-up we've seen in the last week.
What about, though, the fact that OPEC Plus is keeping millions of barrels of oil off the market? Now, I know the bulls say, well, it would take quite a while to actually get that production flowing again, but they are keeping oil out of circulation right now.
Yeah, certainly. And we don't see them making any impulsive move in the near term to unwind those production cuts. We think they will still unwind as per what the message to the market starting in May, as April's the final month of those sort of voluntary cuts. Mm-hmm. And they're really focused on keeping global inventories below the 5-year average. And I think fundamentals will be the key barometer to watch in terms of how OPEC unwinds those voluntary cuts.
Is OPEC, just looking at, say, the North American price, I know that's a bit parochial, but we've seen it hitting $80 today. Is that the kind of price level where OPEC Plus is happy?
Yeah, I think generally what we've heard from OPEC is that anywhere between 70 and 90 Brent is sort of that sweet spot for both demand and supply. It works well for them. I'm sure they would like it higher, on the higher end of that range. But I think we're getting into that. And I think the higher price goes, and if inventories do not build globally, the more likely it is you're going to see them unwind and try and manage the market accordingly.
Just now, I know speculating what President-elect Trump will do or won't is a bit of a mug's game. He is inaugurated Monday. But do you think he would do something as extreme as putting a tariff on Canadian oil that America buys 4 million barrels a day or so from this country?
Yeah, I think our current base case is it will be announced on day one. We don't think it will go into effect on day one. We think there'll be some window for negotiation to occur for him really to get the concessions on border security and drug smuggling, which he's really targeting in our minds. So we're optimistic that those negotiations will be fruitful before that effective date. But it is a risk that's becoming increasingly real, and we're seeing it reflected in oil market pricing, especially on some key differentials that Canada produces.
Jeremy, thank you very much indeed for joining us.